Stand by, sir. Five, four, three, two, one.
Hello and welcome to the Mutual Fund Show. My name is Neeraj Shah. On the next 20-25 minutes, we'll talk all about funds. And the topic today that we've chosen is, international funds, the options available, the reasons why or why not you should choose funds to invest into. There's a new fund offer from Mire, which we'll try and ask our guests to speak a bit about, because a lot of you have requested on social media about that. And since it's a new fund offer, we anyways discuss those on our shows. And lastly, maybe try and get some thoughts on which are the funds that are getting transacted the most on his platform. Gaurav Rastogi, founder of Kuvera, joins in on the show. Remember, viewers, Kuvera is a platform that lets you invest into mutual funds and a bunch of other things, but predominantly mutual funds. So if you want to invest into funds directly without the need of an advisor, Kuvera is one such platform which allows you to do so. Gaurav, thanks so much for joining in. Hope all is safe.
Thanks, Neeraj. Thanks to having me on the show again. All's well. Hope all's well on your end as well.
Touch wood. All safe, Gaurav. Couldn't ask for better. So let's start with this, Gaurav. There is a rush of fund options getting available. Mire's joined the bandwagon. We'll talk about that in a bit. But since you run a platform wherein a variety of people must be coming in to invest into funds and international funds, what is your experience when you slice data, when you look at the portfolios and try and figure out what kind of people should invest in international funds?
So let's kind of break it down into 2 or 3 different parts. So let's say the first part is who should invest in international funds. Ideally, everyone should have an international allocation in their portfolio. Allocations are percentages of your portfolio, right? So it doesn't matter how big your corpus is. Someone who's doing a 5,000 rupee SIP versus someone who's doing a 50,000 rupee SIP versus someone who's doing a 5 lakh rupee SIP. As a percentage of your portfolio, if the minimum requirements are allowed by a fund, then you should think about international investing for multiple reasons. And I'll just give you a quick rundown on why one should think about this. The biggest, of course, is diversification. We usually look at S&P 500, and what we find is over the past 20 years, the 3-year rolling correlation, which basically means does S&P 500 and Nifty 50, do they move together, or how much do they move together? So assets which move together don't add diversification to your portfolio. Assets that don't tend to move together add diversification to your portfolio. So what we find is that the 3-year average correlation in the last 20 years is about 34%, which is kind of what is the correlation you will find between G6 and Nifty 50 as well. So it does provide you diversification. Second is if you think about the MSCI Global Index, the way we sometimes we have said this before, is if an alien lands on Earth, has no idea about what is India, what is US, wants to own an index portfolio, by default they'll end up owning 66% of the US market, because that's the weight in MSCI World Index. By the lottery of birth, we are born Indians does not mean that we have to have disproportionate investments in India. There's a term for this. The term is called home bias. There is a tendency for investors to disproportionately invest more in their home country asset, or the asset that they know best. So these are some of the reasons, right? The US companies, they generate about 29 to 45% of their incomes from abroad. So diversified portfolio gives you global exposure, helps you avoid this home bias, which is kind of actually if you think about it, it's just a lottery of birth. So pretty much everyone should have international exposure. Coming to the second question, who is actually investing and how much they are investing, right? So that's very interesting for us also to look at the data. So on average, what we find is that across all the portfolios, roughly about 5.5% of the portfolio is allocated to international exposure, and majority is through mutual funds. Is this the right amount? Very hard to say. Our math says that the allocation should be somewhere in the 10 to 20% range. In the past, we have recommended roughly about a 13% allocation to international assets. That is going back to 2017. What are people investing in is again very, very interesting, and this both the questions have also, and also your observation that there has been a flux of international funds recently, have also to be looked through the lens of what have international funds done in the recent past. Whether you look at Nasdaq, whether you look at S&P 500, the returns have been really, really good. Fund houses are seeing that. Investors are also seeing that, right? So we do see that Nasdaq 100 fund is very, very popular. There's a Nasdaq 100 fund from Motilal. I think it's one of the oldest Nasdaq 100 fund out there. That's very popular that users invest in. When we first recommended international funds in our portfolio, that's back in 2017, there were, I think, our choices were limited to 4 or 5, and out of which also a couple of them were like sectoral funds, right? There was the DSP Mining Fund, which is a pretty old fund. There is a DSP Agriculture Fund, which is also a very old fund. But if you look at broad market funds, I think Franklin used to offer one, and Franklin offers one. They still offer one. I shouldn't say used to. Franklin offers one, and ICICI offers one. And our recommendation was the ICICI US Blue Chip Equity
Fund. And there are, on last count that I saw, maybe 38 to 40 offerings.
Sure.
Not all the offerings have US as their core. Yep. Some have other geographies. Some have themes at the core as well. Yep. Should people diversify within there too, or just keep it simple and maybe stick to US right now as the starting point of diversification?
And see, our view, and this is a view that we have kind of mentioned again and again in the Indian context also. Sector timing is very hard. It's very hard to time Indian IT, Indian pharma, and most people, they lag, right? I mean, the sector moves, then a flood of money comes in, and then the sector derates, and then that money goes out. So even though the sector has a certain performance, most investors are not able to capture it, which is what is popularly known as the behavioral gap. So the same thing applies in the international context also. We would suggest that don't look at, I mean, it's good to know that you can invest into mining, or you can invest into specific sectors, but it's very hard to time it, as it is hard to time Indian sector. So unless you have some expertise or some kind of advantage or edge in the way that you analyze the markets, the macros and the micros, we would suggest stay away from it. When it comes to regional exposure, right? Should you go for a greater China fund, or an Asia fund, or a European fund? They're not bad. They're also well diversified. They're targeting a very large GDP area. So it's not like you're investing in a small country. You're investing in a country with a substantially large GDP. So they're fine to have. The only edge, I think, that a broad US market has, and some of it that I mentioned earlier was, if you look at S&P 500, then I think 2020 data says that 30% of their revenues come from international sales. If you look at Nasdaq 100, about 45% of their revenues comes from international sales. So although what you're buying is a US index, you're actually getting a truly global exposure, which will be missing if you go for some of the other regional funds. European companies do not have that much international earnings. Chinese companies, Australia is an exception because they're a big exporter of commodities. Chinese companies do not have that much international earnings, right? So some of the other regions actually give you pure regional exposure. And if that is what you want, you should definitely go for that. But you have to understand that that is what you're getting. With US, what you get is you get a best-in-class market, but you also get a global exposure to where are these companies making their revenues and profits from.
Yeah, that's important. Okay, so sticking to US might not be a bad idea, because you don't only get US, you get the rest of the world as well, and maybe a lot more known, a lot more simplistic the process. What about taxation, Gaurav? I mean, is there a different method of taxation that people who invest into international funds should keep in mind? Any idea here?
Not really, right? So you just have to be clear on whether it's like, if it's an equity fund of fund, then so if it's more than, I think, 65% is the benchmark. I mean, I might be wrong with the actual numbers, but if the fund of fund is set up as an equity a vehicle, then the taxation is exactly the same as equity. Else, the taxation is like debt. But you don't have to worry about LRS. You don't have to worry about how does your money go abroad. You don't have to worry about foreign taxes and all of that. Everything is taken care of for you. You only have to worry about Indian taxes. So it will be either taxed as an equity fund or taxed as a debt fund. Both are fairly simplistic in India, but that's all you have to worry about. So taxation wise, mutual fund structure actually scores heavily. First of all, you don't have to worry about sending money abroad. So the entire LRS piece is sidetracked. You don't have to worry about what conversion rate you're going to get. You're not going to worry about what fees your bank is going to charge. You don't have to worry about how will the remittance back into the country happen. So in those areas, if you go direct equity, which you also have on our platform, by the way, and a lot of people do use that, but there you have to be a slightly more sophisticated investor to know what you're doing, because that process, unfortunately, is not as smooth as we would want it to be.
Yeah, that's true. And the other question, Gaurav, was that while the taxation part is not a problem, is there, for example, if people are diversifying into non-US international funds, do they need to bother about factors such as the currency strength or weakness of that particular geography or nation while they are choosing to invest passively through funds? I mean, is that something that people should ideally keep in mind, or no, not really?
Oh no, they have to. They have to. I mean, it's simple math, right? Your international fund return in INR is your international fund return in the international local currency and the currency exchange rate movement, right? So when you invest international, you are hedging INR by buying whatever that foreign currency is, right? Now, that hedge can work in your favor or that hedge can work against you. If INR depreciates against the USD, that hedge is working in your favor. The international fund returns in INR is higher than the fund returns in USD because you're gaining from the INR depreciation. But if INR appreciates against that currency, then you're losing out. Then your returns are low. But see, that's part and parcel of international investing, and it's actually a very good point. Very few people actually think about it deeply. But when you are buying an international asset, and this is not just it could be funds, stocks, whatever, any international asset, the currency exchange rate movement will affect your INR returns.
Got it. Okay, so people,
in a way, you are diversifying away from INR as well. So one way to think about it is you're getting currency diversification and you're getting stock market diversification, but there is no guarantee that it will work in your favor.
Yeah, that's true. That's true. And a lot of times it might become a lot more difficult to analyze an issue compared to a local fund, because the companies, they are one jurisdiction, etc., versus maybe a global fund. Gaurav, just one question. Something that we spoke about, right? That maybe until 2 years ago there were maybe 5 options available. Now there are some 40. Now, which are the ones? I mean, whatever. Either you recommend them, or they are finding a lot of traction because of all the right reasons on your platform, or in general have seen their AUM go up because of their performance or the index that they invest in, what have you. Can you throw some light here? Because I think as difficult as international investing is, when somebody who's starting off, and a lot of people who are watching this would be coming here to also try and understand what the Mira NFO is about, which we will talk about. But a lot of people might not be really experts, and they might get confused when they see 30, 40 names and try and figure out which one to invest in. So one, what are the more popular ones, and are there some red flags that people should be aware of? Maybe the corpus of the fund, or if there is thematic, then avoid it, something that you referred to just a minute ago. I mean, any thoughts here?
In terms of flows, right? So I think Motilal Nasdaq and Motilal S&P, both the index funds that they have, see fairly good traction. And I think they were the first international index funds in some sense. International funds that track an index. They do see a lot of traction on our platform. it is hard. I mean, I agree with you. It is hard. There are 38 funds. It's really hard to figure out which is the right fund that you should be investing in. And it's becoming harder because there are a lot of new fund offerings that are happening. It's a space that is growing. I think there is a much larger realization in the investor population that diversification matters and international diversification matters. And AMCs are trying to fill that demand. They're trying to kind of create products which they think. But effectively, what happens is when you're sitting out of India, there's only that much differentiation you can create. So a lot of the funds will end up having very similar portfolios in terms of, especially if they're investing in the US market, it'll be large cap US, right? If they're investing in other regions, then yes, there is this differentiation that it can be a Japan fund or a Greater China fund, and then they are actually kind of taking really idiosyncratic risk, but that risk is limited to that region. Like I said before, also, right? I mean, there are no red flags in terms of AUM, whether small or large. I mean, compared to the Indian markets and kind of the kind of flows we talk about. At the end of the day, like I said earlier, the international exposure in sum total is just 5.5% of the entire of the average portfolio. That's not much.
Yeah.
And we're not talking about numbers that are going to move any large market. So in terms of AUM, it doesn't matter much. The only thing that you have to be worried about is if the AUM is really small, then a lot of that cost is split over that small AUM. So usually either the expense ratios will not fall, because expense ratios, traditionally what we have seen is as the fund size grows, some of that scale, economies of scale savings that a fund house has for a larger AUM, they will pass it on as lower expense ratios. That will most likely not happen in a small fund, because the small corpus they have has to bear the entire cost of operating that fund. And international funds, there are costs associated with it. There are FX costs, there are trading costs that are associated with it, which the AMC will pass on. Right? So that's one thing you have to take in mind. So I would say if the AUM is like really, really low, then I mean, just ask yourself, is there a really bullish reason to buy this fund, and is this the only fund that gives you that particular exposure? It might still make sense if you have a very strong view, but otherwise, stick with a diversified fund that has decent or large AUM, and most of the large US diversified funds will satisfy that criteria. The only other thing I'll add here is that if you're investing in an international fund of fund, then be very careful that you look at the pass-through expense ratio and not just the expense ratio of the fund of fund. There is not a single established practice on how this is done. Some AMCs, when they disclose an expense ratio, they say, okay, this is the expense ratio of the underlying fund. This is our expense ratio, A plus B. This is the total expense ratio that you're paying. I think under SEBI disclosure, you can only disclose the expense ratio of the fund of fund, and that's also fine. So in some cases, you have to actually dig in and find out, oh, there is another expense ratio of the fund that this fund of fund is investing in. And you have to add that to your cost because it's also coming out of your pocket. So that's just one thing you should also be aware of, because sometimes what happens is a lot of these fund of funds, their expense ratio looks artificially low.
Are there examples that you can cite? I mean, or should people look out for them, search for them?
If it's a fund of fund, just make sure that they are actually. Because I mean, at the top of my head, I don't know, but I know there are. I've seen
there
this before. That you have to, if it's a fund of fund, just make sure that you're looking at the look-through expense ratio and not just the expense ratio of fund of fund.
Got it. Okay, Gaurav, one final question on the NFO that is up at hand from Mire. Well, a lot of people have asked about this. It's open right now. How is it? Please tell us. One, in isolation, is it a good NFO or things that people should keep in mind? And on a relative basis, are there other options like that available which might anyway serve the needs of the investor?
Great. So you're talking about the Mire FA FANG Plus, right? The FANG Plus NFO that's going on right now.
Yes.
So I'll tell you my views on this. These are mostly personal views. What I like about this fund is it's actually, I think, a very, very unique offering in a couple of ways, right? So in the US, there is a money manager called ARC, right? And they do this highly concentrated portfolio. At one point, they were holding 20% of the fund was invested in Tesla, right? So very concentrated bets. I think this is kind of one of the first funds in India that is trying to follow the same philosophy, where they're saying we're going to have 10 positions, 10% each, right? So it's definitely not a diversified fund. The fund carries concentration risk. The fund is not for everyone, right? So you have to be very clear and know what you're getting into. Now, who is this fund for, right? This fund is essentially a big bet on big tech. If you really believe that software will eat the world, if you really believe that the moat that these large tech companies have built can continue for another decade or two, and large tech companies usually have multi-decade moats, so it's not an illogical viewpoint to have, but you have to have these very strong viewpoints to then get into investing into this fund, because this fund will be volatile. You have only 10 names, you have massive idiosyncratic risk. A single Apple miss can mean a lot to you in a fund like this. Or a single, on the other hand, if Apple beats, that could also mean something very different on the upside, right? So that's the nature of this fund. It's a unique offering. It's not for everyone. I would say that the only other risk here is that what happens, how do you rotate these names? You have 10 names. How do you rotate these names? So you are taking a little bit of disruption risk. If any of these businesses gets disrupted, what happens? On the plus side, the other plus side of this fund is that they're rebalancing it back to 10% on a periodic basis. Now, this is actually fantastic. It's an equal weight fund which gets rebalanced. So what happens is, if Apple underperforms, you're buying Apple. If Apple outperforms, you're selling Apple. So a rebalancing effectively is a buy low, sell high strategy, right? So that's one way that they are trying to capture some of that reversion to mean alpha. So, overall, I think it's an interesting option. It's a very unique option. ARK, by the way, the fund that I mentioned, the international fund that I mentioned, have been hugely popular in the US. And they take super concentrated positions. So I think this is the first time someone is trying this out in the Indian market. So I'm also very excited to see how investors react to it. But like I said, it's not for everyone. You have to be absolutely clear that this is a very big bet on big tech.
And if you want to take that, then this is a unique offering, as Gaurav is saying, and not other offerings available in the market like that. So do keep that in mind.
I don't think anyone else offers such a concentrated portfolio, right? So this is definitely one fund which is, you can kind of say that, you can get NASDAQ, but you will not get the same kind of beta or alpha in this fund that you will get in NASDAQ. So that's the difference. It's almost like a leveraged NASDAQ position in some sense, if you can think about it.
Okay. Well, that's a nice way to put it. But Gaurav, take a moment to thank you for joining in today on the show and giving us some sense. We've discussed enough number of times the importance, but it is good to see a unique way in which somebody approaches. And thanks for doing that for us today.
Thanks, Neeraj. Thank you, sir.
And viewers, thank you. Viewers, thanks for tuning in to this leg of the Mutual Fund Show.